Everyone wants your shekels. The world of finance is incredibly powerful, and the more I get to know it, the more it seems to me that it's about tugging the rope, pulling the blanket to your side, and slicing the pie so that you get the biggest piece. I see it every day, whether someone is talking about real estate or some funds. Typically, we very often encounter bullshitting in finance, with some manipulation, with some desire and effort to get your shekels into their own pockets. Today, I would like to look at how not to get ripped off in the world of finance. I've defined a few pieces of advice, a bit haphazardly, that I think if you implement into your life, there's a much smaller chance that someone will screw you over. Let's get to it. The first absolutely fundamental thing, which is right on the surface, is incentives. Understanding how the person who interacts with me, who provides me with a service, is compensated and what motivates them. Because typically, how someone is compensated defines how they are motivated. If I have an hourly rate, then typically I will have some motivation to log as many hours as possible, which we see in some consulting jobs. If I have a success fee, then I need a result for the success fee, and ideally, I need it as quickly as possible. So there is often some pressure to deliver quickly. Even though a success fee is generally a good model, there can be pressure to deliver as fast as possible, regardless of whether it maximizes your profitability. This is because it speeds up the arrival of some success fee to the seller. Then another crucial thing is how the person providing you a service is compensated, and whether they might be rewarded by some third party. And all of this is absolutely essential to understand, no matter who you are interacting with. Simply being clear on how that person is making money in their interaction with you and what motivates them is the absolute foundation of everything. Another thing that's really good to realize in finance is that the higher the level of abstraction we go, the greater the chance that someone will rip you off. At the same time, the less complete the information we are able to obtain, the greater the likelihood that someone will be bullshitting you again. For example, trading is a game with extremely incomplete information, and there is a huge amount of room for bullshitting with you. Bricklaying is a game with more or less complete information, and it rarely happens that, unlike getting ripped off in some trading courses, you get ripped off by a bricklayer. At most, they might overcharge you on wages, but you can clearly see whether the brickwork is done or not. And the higher the levels of abstraction, and typically some high-level finance involves quite a large level of abstraction, the greater the chance that someone will rip you off. Therefore, it's good to start with simple things that you are able to understand, and only then, with some understanding, move on to complexity. This is also connected to the idea that it's good not to be confused by complex terms. I see this quite often in the legal profession, where some lawyers just love to use ex lege and various Latin terms, and it actually makes it seem so sophisticated and similar. It's the same in finance, just volatility here, just some low profile in gamma, delta, beta, and so on. Often it's because people normally express themselves this way in their profession without any problem. Often it's because if I throw complicated terms at you, I'll look pretty smart. A lot of you won't get it. For some of you, it will be like, wow, this is probably too much for me, but that guy must know what he's doing because he's talking in a way that I can't even understand. So what's another piece of advice? Don't let yourself get overwhelmed by complicated terms. Another absolutely crucial rule in finance is that you need to know two very important variables. Whatever you do, these are the two very important fundamental variables: risk and reward. How much potential reward can I gain and how much risk am I taking on? The amount of potential rewards you can get is usually relatively easy to read. It's very simple, so there usually isn't a problem there. The problem often lies in how much risk you take on, because most of the various fund sellers, different real estate products where they simply leverage you and the like, usually don't tell you anything. Most of the time. When you walk across the sidewalk, it's not completely safe either, you know. I heard answers like that just recently. In this regard, it's really good to ask about the risks. At the same time, it's a great litmus test of who you're interacting with, whether they can tell you the risks, whether they can tell you the limits of what you're doing, and he should even point out those risks on his own. For example, when we are dealing with a corporate structure, I don't dare to proceed further without explaining how the corporate structure works. And the very next point is to explain where it might fall apart, because that's absolutely crucial for any decision making. And if I were to sell it like, hey, here, it's all good, nothing in life is without risk, you know? And like, when you get on a plane, no one says it won't crash, and there's always some risk. So if you're scared, then don't go into the woods and things like that. That's completely off. It's essential that the person who helps you make decisions guides you through the world of risks, and I would even say that understanding the risks is much more crucial than the reward, because those risks can wipe you out. If you have some amount of money and do nothing with it, that's fine. You'll stay at zero minus some inflation. But if you make an investment decision, there's simply the potential to flush it down to zero. At the same time, what is good to understand, and no matter who tries to say what, this is another ultimate truth. If you want to outperform the market, meaning some index, some S&P, what it typically delivers, then anything I want to earn above the market, which means around 10% TA, I necessarily understood that obliged to take the risk of complete capital liquidation. It's simply a complete mantra. If I want something more than what the market usually delivers, I am capable. I have to take on some adequate risk. There will be ultimate cases where this won't be the case, where there's simply 20% on the table and the risk is small. Such cases exist. The market isn't perfectly efficient. Typically, you won't know about it, and typically no one will tell you about it because they will exploit that inefficiency entirely for themselves. This means that for an average user, if you want anything more than 10% PA, you have a high potential of losing your entire capital. Respectively, not a big one, but some, you are facing the potential for capital loss. This potential exists even with those 10 pascals. But if I go to the market, I have to take on more risk than the market does. It's absolutely essential to understand this, and it's really the alpha and omega. Another thing that needs to be meticulously and extremely monitored are the fees. What will ruin you, what will make you a performing fool are the fees, absolutely. This is something that isn't very visible, something that many people terribly overlook, but whether I buy something for 100 or 98 makes a huge difference. Those 2% on entry are absolutely crucial because I will be entering so many more times. Those fees can really eat me up brutally. This also applies to fund fees. Typically, funds perform below the index and usually underperform the index by approximately the amount of their fees. Whether I pay someone a percentage of the result or something else is absolutely crucial. And I need to know when I want to pay that specific entity, fund, or person, when it makes sense to me, and when. My expected return is positive. And one last thing, my experience at least tells me that the less someone wants shekels from you, the worse the deal is. If someone is raking in thousands, you typically don't get a good deal. You get some average sometimes, like I'm not talking about an index. Now, yeah, I'm not talking about some ETF, but about some fund or similar active management. Simply put, the good funds rarely come to you as a retail investor. The good funds are usually relatively well filled. Well, because they are able to somehow align the elves. They are able to sell the service, show where they simply overperform the individual market. It rarely happens that someone goes to a retailer for 100,000 shekels and at the same time is able to manage that capital very well. What does this stem from? Managing 1,000 people who gave me $1,000 is infinitely harder than managing one person who gave me $1 million. The risks associated with dealing with 1,000 people are infinitely greater than with the one person who gave me $1 million. And at the same time, I will usually have access to the people who will give me that $1 million if I am doing something extremely interesting above the market. So in this regard, you need to keep an eye on how much money that person wants, and it's kind of a yellow flag about how good they might be. This is everything I wanted to tell you. I would love to read about your experiences and findings regarding the market and how it works. Anyway, think for yourself. No one teaches you that. Bye.